American farmers walked into this season not with optimism but with a quiet calculation of how much they could afford to lose. For years, the country assumed its crops would always have a buyer somewhere in the world. That assumption has now collapsed. Soybean contracts that once kept entire counties alive have evaporated. Corn shipments are piling up with no destination. Wheat, once a symbol of American reliability, now sits in silos longer than any farmer is comfortable admitting. The shock began when nearly all upcoming soybean export contracts disappeared, wiping out a market farmers had depended on for decades. But the real story is what followed: a broader unraveling of trust, trade, and basic economic stability across the Farm Belt. The numbers define the crisis more clearly than any anecdote. Soybean exports to China have fallen by more than 1/5, while global buyers continue redirecting their orders to Brazil, Argentina, and Canada. Grain elevators across Iowa and Illinois report that wheat inventories have risen by double-digit percentages, a sign that foreign mills have moved on and might not return. And now, the financial pressure is reaching breaking point. Total American farm debt has climbed above $540 billion, the highest in U.S. history. Even as incomes in rural communities continue to weaken, real farm income has dropped by more than 27% since 2021, a decline so steep that it rivals the worst downturns of the early 2000s. When margins are already razor-thin, a fall of that scale can turn survival into a mathematical impossibility. At the export level, the trend is just as grim. The total value of U.S. agricultural exports has slipped to roughly $170 billion, reflecting not only lost sales, but a long-term shift in the way global buyers evaluate risk. America is no longer seen as the steady, predictable supplier it once was. Constant tariff changes, regulatory whiplash, political brinkmanship, and unpredictable shipping schedules have transformed U.S. crops into what overseas importers now describe as a high-risk commodity. In an industry where delivery delays can shut down entire food processing plants, buyers do not gamble on uncertainty. They buy from countries that keep politics out of the paperwork. Meanwhile, the domestic cost structure continues to move in the wrong direction. Fertilizer, fuel, machinery parts, and even storage fees have grown more expensive. Interest rates have locked many farmers out of essential credit. And when debt grows faster than revenue, the result is a silent tightening around every operational decision: how much seed to buy, how many acres to plant, whether to fix a broken combine, or just hope it makes it through one more season. Across the Midwest, producers say they are no longer managing farms, they are managing losses. This is the new reality for American agriculture. The country that once fed large portions of the world is now struggling to find stable markets for its own crops. And with each passing month, the consequences grow heavier, not only for farmers, but for consumers who depend on their work. American agriculture was never supposed to stall this fast. Yet, across the heartland, the core export engines of soybeans, corn, and wheat have all seized up at the same time. What began as a sharp drop in soybean demand has now widened into a system-wide blockage, leaving grain piled in storage, clogging rail lines, and overwhelming port capacity. The numbers read like the anatomy of a collapse. Soybean shipments that once moved with clockwork regularity are now stuck behind a wall of vanished contracts. Corn exports have slowed so dramatically that some producers admit they are storing grain in improvised sheds because every commercial silo within driving distance is full. Wheat, the crop that American farmers once viewed as their most dependable export, has become the clearest sign of the new reality. Oversupply at home, no buyers abroad, and no clear path out. This is not happening because Americans suddenly grew more grain than the world needs. It is happening because the world no longer wants to rely on American supply chains. Importers in Asia and Europe have restructured their sourcing to prioritize predictability over price, and the U.S. no longer offers that stability. Soybean exports to China have fallen by more than 22%, the result of both strategic sourcing shifts and a global market that is increasingly comfortable bypassing the United States entirely. Wheat inventories across the Midwest have risen by roughly 17%, the highest level in more than a decade, a metric that tells its own story. The grain is ready, but the ships are not. And while farmers wait for contracts that never materialize, the cost of getting grain to market has shot up as well. Transportation costs for grain have increased by nearly 18%, driven by fuel prices, port congestion, and inefficiencies that competitors like Brazil no longer face. The consequences ripple outward. Ships idle at West Coast ports because containers sit half-filled with unsold product. Rail companies cut back on service after months of reduced volume. Some grain handlers report turning away deliveries simply because they have nowhere left to store them. For many producers, the only temporary relief comes from renting warehouse space at sharply inflated rates if they can find any. Others are confronting the reality that some of their crop may rot in the field, not due to weather or pests, but because the economy built around moving grain has gone motionless. The most striking shift is psychological. Farmers have long weathered droughts, storms, price swings, and the whims of global markets, but they rarely faced a moment when all three major crops stalled at once. Today, the calculus has changed. Instead of planning for profit, farmers are planning for the smallest possible loss. They are delaying sales, waiting for price bumps that may never come, and debating whether the cost of planting another acre is worth the likelihood of selling it at a deficit. This is not caution, it is survival strategy. What was once a dynamic export engine is now a slow-moving gridlock, the kind that cannot be fixed by a single policy or a lucky shift in commodity prices. The system itself has frozen, and until global buyers regain confidence in American consistency, which could take years, the grain will keep piling up, season after season. The unraveling of America's wheat market became undeniable when 5 long-standing customers, the Philippines, France, South Korea, Mexico, and Italy, quietly walked away. These weren't symbolic gestures, they were structural decisions made by food processors, millers, and importers who no longer viewed American wheat as a dependable product. For decades, U.S. suppliers assumed loyalty was built on quality and price. But global buyers are now making decisions based on something far more pragmatic: risk tolerance. And in their calculations, the United States has become the riskiest option on the menu. The Philippines was the first to make the break. For years, it relied on American wheat for up to 9/10 of its milling needs. Today, buyers there describe U.S. shipments as unpredictable, a diplomatic way of saying the delays, paperwork changes, and logistical breakdowns became too costly to ignore. They shifted orders to Canada and Australia, countries whose export systems rarely change with political mood swings. France followed, not in protest, but in self-preservation. French bakers require precise protein content and reliable delivery windows. American wheat once met those needs. Recently, however, it has failed on both counts. Millers in Marseille and Rouen have grown tired of adjusting their operations for late or inconsistent shipments, preferring suppliers who deliver exactly what they promise without requiring policy guesswork. South Korea delivered the clearest signal that the era of automatic American dominance is over. U.S. wheat's share in the Korean market has fallen below 20%, while Canadian suppliers now control more than 60%. The result of cleaner residue profiles, faster logistics, and fully digitized traceability systems that reassure Korean regulators. Mexico's shift was more subtle but equally revealing. As a neighbor, it has every incentive to buy American grain. Yet contracts were delayed, documentation changed without warning, and shipments missed critical production windows. Eventually, Mexican food companies stopped waiting. They turned north instead of northward. Italy's departure stung most. For decades, American durum wheat helped shape the global pasta industry. Italian manufacturers once treated U.S. shipments as a dependable fallback even during domestic crop shortages. Not anymore. Their pivot to Canada had nothing to do with price. It was about consistency. Italian processors need grain that meets precise moisture and gluten specifications with 0 deviations. American wheat no longer carries that guarantee. Meanwhile, Canada has increased its wheat exports to Europe by more than 40%, backed by strict carbon, residue, and traceability standards that align with EU regulations. The pattern is unmistakable. America didn't lose these customers because its wheat suddenly got worse. It lost them because the world lost patience with systemic uncertainty. When a shipment's success depends on the political temperature in Washington or sudden tariff changes, global buyers look elsewhere. And once supply chains move, they rarely move back. These 5 countries were not outliers. They were early indicators of a global market that now views U.S. agriculture the way investors view volatile stocks, potentially valuable but too unstable to anchor a portfolio. China's retreat from American agriculture was not a gradual cooling, it was a decisive severing of ties that reshaped global grain flows almost overnight. For years, U.S. Farmers depended on China as their largest and most reliable customer for soybeans, sorghum, almonds, dairy, and meat. That dependence became a vulnerability the moment Beijing introduced retaliatory tariffs that effectively priced American products out of the market. The impact was immediate and brutal. Sorghum exports, once dominated by shipments to China, collapsed so sharply that entire segments of the industry were left without a viable buyer. Almond and dairy exporters reported cancellations within days, not months. At the port of Oakland, refrigerated containers filled with perishable goods began to stack up in clusters waiting for ships that were no longer coming. The economics leave no room for doubt. China's new tariff regime, reaching well above 100%, did more than punish American farmers. It rewrote the incentives that dictate how global supply chains operate. Importers are not sentimental. They buy from whoever can deliver reliably, predictably, and at a competitive price. Thanks to a multi-year shift in sourcing strategy, that supplier is no longer the United States. China's soybean imports from Brazil have increased by roughly 28%, reinforcing a long-term partnership supported by new rail links, expanded Amazon ports, and aggressive investment from both governments. Meanwhile, American soy futures continue to slump, not because of weak harvests, but because the market they were built for has vanished. The sorghum market tells an even clearer story. More than 9/10 of U.S. sorghum once went to China. Today, that pipeline has essentially closed. With no secondary markets large enough to absorb the volume, producers face impossible decisions: sell at steep losses, store grain indefinitely, or abandon acres altogether. Port operators have reported dozens of blank sailings, including 68 cargo cancellations within a single month, illustrating just how quickly trade routes can collapse when political pressure replaces economic logic. For exporters who rely on containerized shipments, rising freight cost fueled by congestion, retaliatory slowdowns, and extra insurance requirements have turned even successful sales into near break-even exercises. The consequences inside China are equally revealing. Instead of scrambling for replacement suppliers, Beijing executed a textbook diversification strategy. Long-term contracts with Brazil and Argentina locked in steady flows of soybeans and corn at prices shielded from tariff volatility. New agreements with Canada secured wheat and specialty grains, with traceability standards that meet China's tightening safety regulations. As a result, America's role in Chinese food security has diminished from central pillar to optional alternative, a fallback the market no longer needs. The most important lesson is not about China's assertiveness, but America's miscalculation. Trade relationships are not light switches. They cannot be shut off and flipped back on without consequence. When a buyer reforms its entire infrastructure, rail lines, ports, storage, quality protocols to accommodate new suppliers, that decision becomes permanent. Washington can talk about reopening markets, but Beijing has already built new ones. And those markets now operate just fine without the United States. What remains is a farm belt absorbing the impact of a geopolitical gamble that farmers never asked to play. The financial collapse hitting American farms is no longer just an economic issue, it has become a human one. In small towns across the Midwest, the crisis is shaping daily life in ways that statistics alone cannot fully capture. Yet the statistics are devastating. Bankruptcy filings among family farms are on the rise again, reversing years of stability. Farm bankruptcies increased by more than 12% over the past year, with the heaviest spikes in states that once formed the backbone of U.S. grain production. Loan officers report that an increasing share of farmers now arrive not with business plans, but with folders full of overdue bills and shrinking collateral. The combination of weak export markets, high operating costs, and unstable prices has created a financial squeeze that is pushing many long-standing operations past their breaking point. Debt hangs over everything. Total farm debt in the United States has surpassed $540 billion, and it is not abstract. It appears in every delayed equipment purchase, every postponed repair, every acre left unplanted, because the credit line has no room left to stretch. While interest rates have climbed steadily, income has moved in the opposite direction. Real farm income has fallen by more than 27% since 2021, meaning farmers are producing more risk for less reward than at any point in recent memory. For families who have worked the same land for 3 or 4 generations, these numbers aren't economic indicators, they are eviction notices in slow motion, but the emotional cost runs deeper than the financial strain. Mental health hotlines serving rural counties report surging call volumes. Counselors describe farmers who stay awake worrying not about profit but about survival, praying they can refinance one more season, hoping their children will have a future that does not involve inheriting insurmountable debt. At co-op meetings, the silence between discussions has grown heavier. One farmer admitted he might need to sell the land his grandfather cleared because there is no path to break even. No one in the room had a rebuttal, because they all recognized the same fear in themselves. This sense of despair is compounded by the labor shortage. Farm labor availability has declined by roughly 11%, driven by tighter immigration rules and rising wages for the few workers who remain. With fewer hands available, harvests take longer, spoilage increases, and the cost of running even a modest operation climbs. Some farmers who once hired seasonal crews have simply stopped planting certain crops because they cannot secure the labor needed to harvest them on time. The farmland remains fertile, the system around it does not. Perhaps the clearest measure of rural anxiety comes from surveys showing more than 1/4 of American farmers are considering selling their land, the highest share in years. This is not a sign of opportunity, it is a sign of exhaustion. When the people who feed the nation no longer believe they can sustain their own families, something fundamental in the economic order has broken. And while policymakers debate trade strategy on television, the consequences of those decisions are unfolding quietly in barns, fields, and kitchen tables across the heartland. The farm crisis is not distant or hypothetical. It is here, it is personal, and it is stripping rural America of its stability one family at a time. No part of the farm economy captures the divide between corporate strength and rural struggle more clearly than the machinery sector. Across the Midwest, nearly 3,000 tractors and combines sit parked not because they are broken, but because farmers have stopped using them in protest and in resignation. The quiet fields are not a symbol of laziness or defiance. They are a sign that the economics of modern farming no longer add up. Prices for new equipment have surged in recent years, driven by supply chain disruptions and rising production costs. Machinery prices have risen by more than 12%, pushing essential tools beyond the reach of small and mid-sized operations. Meanwhile, the companies that manufacture those machines are thriving. John Deere, long associated with rural identity and American agricultural heritage, now behaves more like a tech corporation than a traditional equipment maker. Its newest models rely on proprietary software systems that control everything from diagnostics to basic operation. Repairs that farmers once performed themselves now require authorized technicians and expensive service fees. Subscription software has replaced mechanical simplicity, meaning a farmer can spend hundreds of thousands of dollars on a machine but still lose access to features if a payment lapses. For a growing number of producers, the relationship feels less like ownership and more like a lease disguised as a purchase. Wall Street, unsurprisingly, loves this model. Deere's revenue increasingly comes from high-margin digital services, not from selling more tractors. Analysts predict that Deere's share price could climb by roughly 20%, powered by recurring subscription revenue and a shift toward automation. In financial terms, it is a brilliant strategy. But farmers see something else, a company distancing itself from the people who built its reputation. It is hard to maintain brand loyalty when you need a software update to harvest corn. That disconnect grows more painful when paired with the cost of credit. Farm borrowing costs have risen by nearly 40% compared to pre-pandemic levels, a direct result of high interest rates pushing equipment loans into unaffordable territory. A purchase that once stretched a family's budget now threatens to collapse it entirely. In conversations across the Farm Belt, farmers describe equipment financing as a gambelone that assumes stable markets, predictable prices, and consistent export demand. None of those assumptions are true today. As margins shrink and uncertainty rises, many operations simply cannot justify taking on new debt for machines they may not break even with. The result is a widening gap. Corporations posting strong earnings while the customers they depend on are immobilized. In another industry, that imbalance might be sustainable. In agriculture, where farmers cannot plant or harvest without machinery, it becomes a structural threat. Fields fall idle not because the land is failing, but because the business model around it has stopped functioning. Modern agriculture was supposed to make farming easier. Instead, it has created a hierarchy where technology flows upward and risk flows downward. And for many farmers, the message is unmistakable. The future of their livelihood is being engineered in boardrooms, not in the fields where they work. The broader landscape of global agriculture is shifting in ways that leave the United States more spectator than leader. For decades, American policymakers assumed the world would always depend on U.S. crops. That assumption is now being dismantled by competitors who invested in infrastructure, logistics, and market stability, while Washington cycled through tariff battles and political theatrics. Brazil has emerged as the new superpower of agricultural exports. It now leads the world in soybean shipments and continues expanding its global footprint with year-over-year growth that has rewritten trade flows, supported by new rail corridors, upgraded ports, and long-term contracts that foreign buyers can actually rely on. Meanwhile, Canada has executed a quieter but equally consequential rise. Canadian wheat exports have grown by nearly 20% globally, with shipments to Europe increasing by more than 40%, thanks to strict residue standards, carbon protocols, and digital traceability systems that align seamlessly with the demands of modern importers. The United States, by contrast, is moving backward. Total agricultural export value has slipped to roughly $170 billion, the kind of decline that signals not a temporary dip but a structural loss of global confidence. Foreign buyers are not just shifting suppliers, they are redesigning entire supply chains around the assumption that American policy is unpredictable, American logistics are vulnerable, and American trade relationships may collapse with the next press conference. Competitors are stepping into the gap with better infrastructure, more stable regulatory environments, and a willingness to negotiate long-term agreements that Washington has repeatedly failed to provide. Domestically, the consequences show up in the grocery aisle. Even as U.S. farmers struggle, consumers are paying more for food because higher transportation costs, unstable supply chains, and reduced domestic production ripple through the entire system. The irony is hard to miss. The country that once fed half the world is now dealing with rising prices at home and shrinking relevance abroad. The Farm Belt has become a casualty of strategic drifter region, asked to absorb the consequences of decisions made far from the fields that bear the impact. The danger is not that America will run out of food. It won't. The danger is that the economic foundation of rural America is eroding, leaving behind hollowed-out towns, shuttered co-ops, and a shrinking workforce, with little reason to believe the future will be better than the present. Agriculture is more than an industry, it is the spine of the national economy. Once that spine weakens, the consequences radiate outward into manufacturing, transportation, energy, and even national security. Losing global agricultural leadership is not just an economic setback, it is a geopolitical one. What remains unresolved is whether the United States will treat this moment as a warning or another headline to ignore. The world has already moved on to new suppliers. If America wants to reclaim any part of its former role, it will need stability, strategy, and a commitment to rebuilding trust that has eroded over years, not months. Thank you for watching. What do you think about this situation? And where do you believe American agriculture is headed next? Let us know in the comments.